Thanks everyone for joining. I'm Eric Major. I'm a managing director with Provident Healthcare Partners. The latest in our webinar series, we're going to be talking about the physical therapy industry and the current wave of consolidation. Certainly, private equity investment and consolidation in PT is not a new theme. We've been seeing pretty significant amount of activity in the space over the last 20 years or so. But the webinar will certainly focus more on the current state of the market and a lot of the themes that we're hearing about, particularly around value-based care. In this webinar, we have the perspective of an M&A advisor with Provident. We also have two other panelists who will have introduced themselves in a second here, but we have an experienced investor who's active with a physical therapy platform, as well as an attorney who deals with a number of physical therapy transactions across the country. So I'll hand it over to Paul initially just to start with introductions, and then we'll have John and Jake do the same.
Thanks, Eric. Look forward to the presentation today. My name is Paul Welk. I'm an attorney at Tucker Arnsberg. We're headquartered out of Pittsburgh, Pennsylvania. We're a full service law firm, and I personally co-chair our merger and acquisition practice group, as well as our healthcare practice group. I am a physical therapist by background, but have been treated clinically in a number of years. I transitioned over to working as a full-time attorney about 15 or 20 years ago, and have had the chance to work on a few hundred rehab transactions, over the last number of years. And that's really the perspective that I bring today, and look forward to presenting with the group. With that, I'll turn it over to John.
Thanks, Paul. I'm John Trinchero. I'm a director with Rally Day Partners. Rally Day is a lower middle market focused private equity firm based out of Denver. We're a little bit of a twist to traditional private equity in that all of our partners and the founders here at Rally Day, we're all entrepreneurs by background. So we've got a heavy focus on partnering with founder-owned businesses. And our hope is that the financial capital we bring to the table is hopefully the least important thing we do in the partnership, but more importantly, that we bring experience to the table with operators that have kind of been there and done that. And that's, as Eric mentioned, why I'm here today. We made an investment in Performance Physical Therapy, which is a physical therapy asset based in Rhode Island. About a year ago, the founder and CEO there, Michelle Cawley, was a huge thought leader in the space. And I know we're going to talk about it throughout the webinar today and a lot of the trends we're seeing, but it was certainly something that resonated with us. And so we made that investment about a year ago. Jake, I'll kick it over to you.
Thanks. So I'm Jake Vesely. I'm with Provident Healthcare Partners. So we're a boutique-focused investment bank with offices in Boston and New York. And as our name alludes to, we focus entirely on the healthcare space. And within healthcare, we work exclusively in healthcare services. Beyond that, we have a particularly strong track record of representing founder-owned and operated businesses who are going through their first transaction event, whether that be partnering with a private equity firm to form a new platform or joining forces with one of the existing organizations in the space. To date, we've closed over 175 transactions across various healthcare services verticals, and we have a strong track record within the musculoskeletal space, including orthopedics, pain management, and most relevant here, physical therapy. So we're looking forward to sharing some of our insights that we've been seeing within the space in this webinar today.
Great. Thanks everyone for the intros. I think the first topic we wanted to talk about is just the recent consolidation trends in physical therapy, and really what we're seeing at a higher level in terms of drivers of investment and consolidation activity. I think the biggest theme that we've certainly seen on our side, and we're hearing from investors, and we'll talk a lot about this in this webinar. I think the concept of value-based care has been discussed ad nauseum across many areas within healthcare over the last decade plus. I think we're starting to see, value-based care actually come to fruition, and payers are starting to get up to speed on different bundle payment models that I certainly are applicable to the PT space. So I think, one of the big topics, again, we'll focus on is, how do physical therapy, practices best position themselves for value-based care, and how are investors kind of viewing their positioning when they make an investment into a PT practice. I think we're also seeing patients are increasingly taking control of their care as well, and seeking the highest quality providers and best patient experience. So certainly an element of consumerism that's impacting the PT space as well. Another big theme that's been a theme in the industry for a long time, but again, something that's continued to be emphasized is physical therapy as a first step treatment option. We've seen obviously a lot of data that's been published about really strong proven outcomes for patients with MSK conditions, and PT, as a first step treatment option, I think is positioned very well to save the healthcare system, probably tens of millions, if not billions of dollars of spend. So I think whether it's through PCP referrals or direct patient access, which is probably the preferred route, I think that the theme of first step treatment option for PT is certainly resonating in the market, and I think a big driver of investor interest. And lastly, I think the market still remains very fragmented, even though private equity and publicly traded companies have been consolidating PT now for the last 20 years or so. We're still seeing a lot of market fragmentation in certain pockets of the country, and we're also seeing a lot of private equity backed groups are starting to consolidate together. As there's been several transactions over the last couple of years where a private equity backed group has merged or sold to another private equity backed group, as we sort of enter into the next phase of the consolidation in the space. But I'll let John chime in. In terms of Rally Day, obviously you made an investment within PT relatively recently. I mean, what were some of the main drivers of your interest in the market and your thesis in the space?
Yeah, I mean, I think you hit a lot of it, Eric. A big one's obviously the demographic trend we're seeing and the demand for services on the physical therapy side. And I know we'll talk a little bit more, particularly on that point, as the PT as the first line of defense or step in care for patients and that direct access. We're a huge believer of that, and the platform we're invested in is looking to push that forward. And then fragmentation was a big one for us as well. I've often heard the joke that we're in like the second or third inning of consolidation, but that's been going on for like almost a decade plus now, as it seems like there's still probably 80-90% fragmentation in the market of small independent practices. And again, I know we're going to talk about it a little today, but part of our thesis is trying to create maybe a third option for those independent practices that are looking to partner up and scale their business, but might not necessarily want to sell to some of the larger strategics in the marketplace, and or folks that are more focused on that fee for service, grinding out patient volume versus a value-based care approach to taking care of patients. And so that was a big investment thesis for us, specifically as it related to our asset in performance physical therapy.
Great. Thanks, John. And Paul, I guess, what are you seeing on the legal side, regulatory, other changes in the market that might be, impacting consolidation or investment activity?
Sure. And I think a lot of the, regulatory legal payment changes, are driven by payment. I think from my perspective, in terms of what I see in driving activity, whether it's changes in Medicare fee schedules that are changing and generally lowering reimbursement rates, whether it's changes in how Medicare reimburses for physical therapist assistance, and ultimately, Medicare's policies are often, then finding themselves into the private payer world. So I think it's looking at that regulation and then ultimately, how it affects the private payer market. And I think, again, when you think about that driver of activity, I don't necessarily see it really as kind of one regulatory event. I think where I see clients that are talking about, looking at opportunities and entering into potential transactions, they are looking at really the overall regulatory landscape. So whether it's, in many of these cases, the owner is also the compliance officer, is also the billing auditor. And I think it's extremely difficult with the constant changes that are going on when you've got, in particular, many of these smaller organizations, they look at opportunities where they can partner with large groups that have the ability to, for example, negotiate better rates with insurance companies, the ability to better gather large amounts of data to support why they are good at providing care when we talk about these value-based options that are out there. The ability to manage data when you don't have the size and the scale. I think that's one of the attractions that these smaller practices are looking. And I think it's largely driven by, more of a global regulatory environment than sort of one item that in particular, causes somebody to say, hey, let's look at options.
That makes sense. Thanks for the insight, Paul. And then I guess, Jake, just from your perspective, in terms of the current state of the market, what are we seeing on the valuation trend side of things?
Yeah, sure, Eric. So, currently there's a lot of noise in the market around some of the macroeconomic concerns like rising interest rates, inflation, and some of the decline we're seeing in valuations in the public market. And one of the most common questions we get is, groups are wondering how this is translating into the private markets. In terms of the lower middle market and the middle market, or deals in the 10 million to 300 or 400 million of enterprise value, we really haven't seen any downward pressure on valuation, both in the processes that we're running and generally what we're seeing in the market. And I think this is really driven by a few things. One is inherently just the value that investors see in the physical therapy space. So John identified a few value drivers, and we're going to talk about the value-based care trends later on in the webinar, but investors really have identified physical therapy as an attractive solution to the growing problem regarding yearly healthcare expenditures, particularly in the musculoskeletal space. So when you combine this with attractive demographic trends, it makes the PT space highly sought after for investment from both healthcare focused private equity funds and generalist private equity funds that are looking to get into the space. Secondly, we continue to have record years for private equity fundraising. And particularly when you think about the public markets and the softening we're seeing there, investors are looking at alternative investment opportunities for outsized returns, and private equity is a great vehicle that can potentially accomplish that. So as a result, there's a tremendous amount of demand for, the quality assets in the PT space, which, we've identified as a very attractive space. And lastly, when you think about the number of independent physical therapy practices remaining each year, it's continuing to decrease as the rate of consolidation increases each year. So, it really leaves you with a severe supply and demand imbalance in the broader physical therapy space, with plenty of dry powder that needs to be allocated. And as a result, valuations have remained at elevated levels. And, I don't really see there being any indication of that decreasing in the near future. Potentially, if interest rates continue to rise, we may see some softening on some of the much larger platform deals, call it, north of 500 million or so of enterprise value, as these ones are more so heavily reliant on debt to hit certain return thresholds. But, we really don't anticipate this trickling down meaningfully to the middle or lower middle market.
Yeah, we certainly see, I think, growth investors within PT making investment in a business that, is in the lower middle market or middle market. Obviously, they're looking at, 5+ year type windows. And I think that the long-term prospects of investing in PT, I think, are really positive, which is still driving significant interest from our perspective. I think the next theme we wanted to transition to is, value-based care. I think from our perspective, we've been hearing about value-based care, going back 10+ years. And I think initially it was probably more of a concept that no one really knew how it was going to be implemented, how it might impact the market, more broadly and specific to PT as well. I think we're starting to see that value-based care is becoming a reality. And I think groups are starting to actually move to value-based care arrangements, whether it's capitation or bundled payments or other models with payers. I guess, John, just from your perspective, being in the space with the investment you made recently, what are you guys seeing in terms of value-based care and how it's impacting, the physical therapy space?
Yeah, look, fee-for-service model, in my opinion, is something all of healthcare is eventually moving away from. And so I think we all can agree that value-based care is coming to physical therapy. It's just when and how will it arrive and fully implement itself. And a big pillar of value-based care is obviously reducing costs and improving outcomes by aligning the incentives with our providers and our payers. And we see that as an enormous opportunity in physical therapy because the PT is not appropriately utilized in our healthcare system right now. MSK disorders or conditions are the single most common healthcare condition. I saw a stat the other week that more than one in every 2 adults over the age of 18 report having an MSK medical condition. However, that being said, in the current system, if I hurt my knee or I hurt my back, I'll have to go see my PCP, who then refers me maybe to a chiropractor or an ortho, probably have some, expensive imaging done. And then eventually I might end up at my PT to actually get treated. And along the way, not only am I wasting a bunch of my time and copays, but I'm costing the healthcare system an enormous amount of dollars to basically get to the end result of where I need to go to treat my issue. And that system's just total bananas. And so At Performance, we have a term we use called PTOTL, and it's a fancy acronym for practicing at the top of the license. And it's really meant to say that our PTs are licensed doctors that are trained to be healthcare professionals to address any sort of MSK issue. And so when a patient has an issue with their back or their knee or their elbow, they should be calling up their PT to schedule an appointment and go get that solved for, not go through 6 different providers on their way to racking up cost and time. And to me, that's the biggest opportunity in value-based care is Eric, as you mentioned in the beginning of this webinar, elevating our PT to be the first step in treating MSK issues, because they're not today, and it's a huge waste of cost. And you also mentioned this earlier, Eric, but research would show when the models followed and PTs are the first line of defense, you're not only saving thousands of dollars per episode with patients on the healthcare spend, but there's massive reductions in the probability of an ER visit, reduced usage of expensive imaging. There's a massive decrease in the probability of an opioid prescription being written, and the obvious downstream effects that has. So I could go on, but to me, value-based care as a start is elevating our PTs to where they should be in our healthcare system as frankly a primary care provider for MSK issues, and the benefit that will have to our entire system, not just the payer or the patient, but all stakeholders, frankly.
All right, thanks, John. And I think, Jake, just kind of transitioning to the investor market. I mean, I think the maybe misconception with private equity is, fee for service models and seeing as many patients and driving revenue and profitability is kind of the core focus of a PT investment. And I think we're certainly seeing, folks like Rally Day and others in the market are approaching PT a little bit differently under the value-based care lens. But from your perspective, how is this sort of impacting M&A activity and investor interest in their strategies in terms of investing into a PT platform?
Yeah, exactly. And I really think, it's the opposite of that fee for service mind today, where private equity investors are really excited at what the potential looks like under a value-based care model. So I think overall we're seeing increased investor interest as a result of some of these opportunities. Like John alluded to, at the macro level, payers of all types are looking at new and innovative ways to pay for value over volume. State budgets on the Medicaid and Medicare side are struggling to keep up with the rising cost of healthcare. On the commercial side, I believe I saw a statistic that said 1/3 of all payments are being made under some sort of advanced payment model now. And investors really have identified physical therapy as one of the best solutions of cost effectiveness and value creation that our healthcare system really needs. And as a result, it's getting investors excited. I think that they really see a first mover opportunity in the physical therapy space, to partner with organizations that can position themselves and execute on these value-based payment opportunities. Just speaking in terms of what the opportunity looks like, I think that if you go beyond, can you save $20 or $30 on a PT visit? But like John mentioned, if you look at how we can prevent extremely expensive downstream surgeries like lumbar fusions or hip and knee replacements or other surgeries that cost upwards of $10,000 or more, physical therapy can have an enormous value add potential. And when you think about this on a PMPM or a risk-based model, there's a lot of upside opportunity that investors can potentially capture, which is getting them excited and leading to additional M&A interest. That said, it's easier said than done in terms of the actual strategy that investors are utilizing here. There has to be significant investment in infrastructure and IT solutions to track the data and track the outcomes. And more importantly, not only do you have to track that data, you have to be able to analyze the data and then very concisely show to payers that you can create a customized care plan that provides tangible cost savings. And that's the more difficult part here. So because of some of these requirements, we're starting to see smaller organizations that may not have the capital or resources needed to set themselves up for success with these initiatives. They're looking towards M&A to partner with larger organizations that could potentially help them in this regard. I think one other strategy we're seeing in the consolidation efforts here is PE firms are considering combining PT with other musculoskeletal offerings such as pain management or orthopedics. When you're managing an entire episode of care, say back pain, for example, it's important to have cooperation between the providers across the continuum of care. for that episode. Like John mentioned, you could have expensive imaging. You could have to go to an orthopedic practice, then you get referred over to a physical therapy practice. Everyone needs to be working towards the same goal of providing the best quality care at a lower cost, at the lowest cost possible. And, investors see the most logical step is simply combining these service offerings under one platform to accomplish that. And then, lastly, when we think about value-based care, I think there's a huge opportunity on the direct to employer care side of things. And, Paul, I know you're seeing more and more of that as well in your work. So maybe I'll pause there and let you share your perspective on, what trends are driving in that space.
Sure, thanks, Jake. And yeah, we are definitely seeing an increased trend in that in the physical therapy space. And it's, direct to employer is certainly not new. We've seen it from clients, the last 10 or 15 years, and certainly before that, I'm sure it happened, but it really seems to be gaining popularity, I think, for a number of reasons. It reduces some administrative burden with, TPAs and those type of issues that come in on the insurance side. I also think that on the administrative burden from the physical therapist, / PT employer side, it reduces their burden in terms of dealing with pre-authorizations when they can deal directly with employers. And more employers are certainly becoming self-insured and have that incentive to, reduce and control costs, maybe in a way either that they haven't had historically or that's continued to grow over time. And I think, you mentioned, Jake, about, data and numbers. I think for those that are getting into this, it's not something you can sit down in a meeting and not know your numbers. So it's something where you really need that robust data, whether you can do it in your current operations or whether you do it with partners that have, better systems or more robust opportunities to gather that information. I think that's a key when you go into the discussion. And, I think some of the attraction, we've talked about the sort of the downstream costs and how PT can help to, address those MSK issues on the front side, with the early intervention and, dealing with issues before they become problematic. We've had clients that our physical therapy practices have come out of meetings with employers who said, boy, you saved us $1 million last year in terms of lost work days that we didn't have, in terms of MRIs, whatever the cost is. And it's real numbers. And I think that's where it creates unique opportunities for physical therapy practices and investors to look and say, okay, let's talk about, really that we're all incentivized on the same side. And then economically, how do we split that, cost savings if it's a shared savings type model, and what does that look like? And, I think, back to the way physical therapy compensation has changed over time, where there's really been a shift to, putting incentives and things in place as opposed to just paying a straight salary, when there was more money there and reimbursement was better. This to me feels almost like a parallel, not exactly, but where you're sort of forced to rethink the model to say, okay, how do we all share the same incentives and then share the same benefits if we achieve our objectives? And I think that's where we're really seeing that direct to employer pitch.
Great. Thanks, Paul. And I guess, John, any other, insights in terms of what you're seeing in terms of value-based care models with performance?
Yeah, I mean, the two things I would add, because I wholly agree with everything Paul said, and I'm glad he went to direct to employer first, is I think that's the more natural route a lot of practices are taking. Obviously, in a perfect world, we'd get our commercial payers to be aligned with similar models, so that it's not just with employers that we're dealing with. I think the challenge there is a lot of insurance companies aren't really organized to operate in those structures. They have marching orders for specific reps to find ways to decrease costs in their siloed areas, but they're not always looking at decreasing costs within the whole health or total cost of care lens. And so that makes that conversation a little more challenging. As Jake alluded to, you've got to have really, really sound data and a lot of outcomes focused results that you can bring to them to really convince them on it. So I think it's coming. It's just a little longer. But the only other thing I'd add on this is I think part of the value-based care model in PT will eventually get to a more of a hybrid approach, where you've seen a lot of these digital providers come out, like Sword Health and Hinge and other ones that are focused on virtual care. And I think there's something there, but I think the challenge with those models is totally eliminating the in-person interaction in physical therapy is is a little bit of a wild concept to me. I think patients have said it, and data would show that in-person interaction is extremely important and valuable to their care. However, I think there's a hybrid approach that combines both an in-person and a virtual setting, particularly in the direct-to-employer setting when you're talking about preventative care, where I'm in the clinic treating certain issues or challenges I might have with pain, but I'm also checking in virtually every couple of weeks or every month with my PT to make sure that I'm doing the exercises that they prescribed to me. I don't have any issues with pain that I didn't have before, et cetera. And so I do think, and we're focused on it as well, finding that right hybrid approach of both in-person and virtual touch will be important for success in the long term.
Great, thanks, John. And I think transition to the next topic, I think we wanted to talk about just what options are available to, PT practices of size and scale in today's market. Jake, do you want to maybe just touch on kind of what we're seeing, if you're a, materially sized practice, looking at, being your own platform versus strategic alignment, maybe just touch on some of the options we're seeing in today's market.
Yeah, sure. So, there's quite a few options for private practices out there. And, I think whenever we're discussing initially with new groups that, the first route they have to determine is if they want to do a transaction event or not. So, the first option is just simply staying independent. And, that said, I think that independent practices are facing increased pressures each year, both on the cost and revenue side. Groups need more size and scale to adapt to some of these regulatory changes and, other potential threats that are coming to revenue, through changes to value-based care and other challenges. And as a result, we're seeing groups really explore two main options, and that's partnerships with either a health system or a publicly traded strategic, or going the private equity route. So, the first one I can touch on is just partnering with the health system or a publicly traded group like US Physical Therapy or ATI. So in terms of the pros and cons, typically these are 100% buyouts, and they're seen as the lowest risk partnerships from a monetary perspective. There's no rollover equity. You're getting 100% of the cash at closing in most cases. So, it's the least amount of risk. There could also be a potentially higher upfront valuation due to cost and revenue synergies. For example, things like higher rates that they could take advantage of day one. That said, that this route really offers less autonomy and independence for, physical therapy practices, and it also really limits their ability to participate in the upside in two meaningful ways. The first is that physical therapy groups are usually either comped either on a salary or on an RVU basis, with no ability to participate in ancillaries or share in the profitability when you go with this type of partnership. And then, second, and perhaps, the most important is, there's no rollover equity in these transactions. And most often, this is what gets our clients and prospective clients excited, is the second or third bite of the apple, or, the ability to roll equity in a growing platform and see multiple liquidity events. And because of this, many groups today are exploring private equity as an alternative. Within private equity, there are a few options. The first one is being a platform, or joining an existing PE platform as a regional platform. And the other option is simply being an add-on or joining forces with an existing platform out there. So whenever we first start having these discussions with, potential clients, most groups want to be the platform, so to speak. But there's really a limited number of groups that can truly qualify as a new platform. First of all, they have to have certain levels of revenue and profitability, as private equity firms do have minimum equity check requirements for starting new platforms. And they also have to have made investments in their infrastructure to support future growth as well. PE can definitely make investments here, but there needs to be a strong foundation in place to support rapid growth going forward. For groups that do qualify as a platform, there are a lot of pros, but there's some cons as well. When you're the initial platform, you're really helping determine the overall direction of, where the platform is going to go in terms of future growth. You have a very meaningful say in almost everything and all decisions. And with that comes a lot of expenses and a lot of time on having to think through all the different issues that may come up and working with your private equity partner to, determine the best game plan moving forward. That said, it does offer the highest potential upside as well. typically you'll get the best economic and governance terms. You'll have the most control over the board seats compared to, the fifth or sixth or 10th add-on that's going to have, a much more limited say in the overall governance and direction of the platform. There's also a little bit of risk in being the initial starting point. And, although I don't think it's particularly high, especially in our processes where, groups are partnering with sophisticated private equity firms that have had success in other areas of healthcare. We typically see the platforms to go on to be very successful, but of course it is higher risk than joining a platform that, has been established for 4 or 5 years. The other option on the platform front is joining an existing private equity platform as a regional platform. This is a great option for groups that don't want to join someone right in their backyard, but may not have the size or scale to be a standalone platform of their own. In a regional platform, the physical therapy practices are given, certain autonomies within their particular region, and oftentimes have a regional holding company that sits under the national holding company. And as a result, they can have, very meaningful equity appreciation attributed to the growth of their particular region, which, a lot of our clients find attractive. And then lastly, within the private equity umbrella, the last option would just be a partnership with, an existing PE backed organization or being the add-on. And this is a really great option for smaller organizations or those that just simply think that they would be more successful by partnering and gathering forces with, like-minded people rather than creating a platform from scratch. And, the pros and cons are really just the opposite of what we just discussed. When you're the add-on, there's lower risk on the rollover equity, and oftentimes you can see appreciation very quickly, if they're 3 or 4 years into their investment cycle. There's also less time and money involved, as you're really essentially just getting plugged into an established organization in those cases. And then, John, I'm sure you have a unique perspective here as well from, the private equity angle, if there's anything that you want to add.
Yeah, I think you summed it up well. In my opinion, physical therapy, frankly, like a lot of industries in healthcare, struggles with options for independent practices. And I think that's why you still see so much fragmentation in the market, even after this consolidation wave has been going on for, decades plus. Because on one hand, going at it alone is tough. Like you mentioned, Jake, it's hard to compete with larger strategics from a cost perspective. And frankly, if we're being honest, a lot of PTs aren't really interested in the accounting and revenue cycle management and kind of back office administration that it takes to run a business. They got into this industry because they wanted to help patients and serve their communities. And so they do have an interest to find a way to exit the management of some of the stuff that they don't want to do and better compete. But on the other hand, selling out is, I think, a phrase you'll hear a lot in this industry, and partially for good reason, because there's some larger strategics out there that are known for having a model that undervalues outcomes versus a focus on the financial levers. And what I mean by that is, in a fee-for-service model, it's quite clear that increasing production or more visits per week for your PTs and more patients per day for your PTs, it's a really nice short-term financial lever to drive profitability. However, it's a terrible long-term perspective for so many reasons. It causes turnover, burnout with the workforce. And it's a business model that isn't really set up for success when value-based care eventually takes a hold of the industry. And so a huge focus for us at Performance is to show, people that are stuck with that decision of it's hard to go at it alone and I don't want to sell out, that there's a third way to go forward. And that's, you can partner with like-minded organizations that elevate the PT's role in healthcare. We focus on outcomes first, and we do this all profitably in a business model that's set up for success in the long term. And so I know we're not the only one out there that has that approach. And I'd imagine more and more independent practices are going to look to partner with folks that have, a similar perspective and a similar vision for where they want to take their practice. And then the other thing I'd add is just part of the pros and cons and kind of decision making matrix there for independent practices is a little bit about their brand and what happens to that as they sell off to another partner, if they're going to go as an add-on or sell to a strategic. And, different companies out there have different approaches, whether they, have a house of brands and a bunch of different more independent local platforms that all roll up to the same holding company, or whether it's the same branded organization across every location across the entire country. And that's obviously a more important of a factor in decision-making process for these independent practices with some versus others. But, our approach is if it's not broken, don't try and fix it. And those brands often carry a ton of weight in their communities from a local marketing perspective. And so we would certainly, with our integration strategy, and I know everyone has different ones, look to avoid forcing a brand name down on practices and frankly removing some of the value in what we're paying for by removing that local brand that connects with the community and the patients that are part of their following. But that is something we've seen specifically in a lot of M&A is the question, what are you going to do with my brand comes up, or what happens to my name, and what does that look like going forward? So it's certainly something I think everyone's got to work through when they go through this process.
And I think historically, to add on to what John talked about, is when you look at the typical demographic of a physical therapy practice owner based on historical data, it's one owner who's owned the practice for a while, is getting near the age of retirement, and in many cases, they've grown a practice that's very successful, or successful to the point that an internal sale is not really an option. So we have a lot of folks that look at that as a first route, but quickly that tends to go away, especially when you get into a larger practice where you have employees and that's just not in their financial wheelhouse to be able to afford to buy a practice. So I think when John talks about that sort of the life cycle, and when you come to the end and you're looking at the numerous opportunities that are out there, many times it is finding that external partner in whatever form, because it's the only way to monetize the asset of the practice that the owner has developed over time. There's really, you come to the end of that individual's career, and there are limited options in many cases as to what to do. So I think that's the folks that we see a lot of coming through our practice, making decisions, whether it's private equity or public or whatever it looks like, because those are the opportunities that are available on the table.
Thanks, Paul. And I think the last topic before we hand it over for questions, we wanted to just touch on the labor markets. Obviously, that's been a hot topic across the healthcare industry. We're seeing staffing challenges and shortages in many different segments of the economy and in the healthcare market in particular. Maybe John, just from your perspective, obviously as it relates to shortage of PTs and maybe other kind of key positions within your platform, how have you guys sort of approached that? And I guess from your perspective, how is Rally Day kind of supporting your platforms, knowing that there's some challenges out there in the labor markets?
Yeah, I mean, starting with the problem first, I saw a stat a month or two ago, I think it was a WebPT report that noted turnover with PTs industry-wide is something like 9% over the last year, which is nearly 3 times the average for the rest of healthcare. So it's obviously a major concern. I'm not sure there's a PT practice anywhere in the country where recruiting talent and retention of that talent isn't a top concern for the C-suite or ownership of that business. And even more damning, perhaps, is there's data that supports more than 2/3 of the workforce is currently considering a career change of some kind. And so when you put up all of the demand stuff that we talked about earlier and how much increased demand there will be for PTs side by side with the supply dynamic we're looking at today, with a lot of PTs thinking about leaving the industry in a massive shortage, it's a huge problem that we've got to address. And I think when you look a little deeper, it's actually pretty clear as to why this challenge is here today. And patient volume has soared in the current fee-for-service model. And so I mentioned it earlier, it's leading to massive exhaustion and burnout with the workforce. Performance metrics are squarely focused on prioritizing quantity over quality. And perhaps the biggest is student debt remains massively disproportionately high as a burden for graduating PT students compared to the cost of living and wage environment that they're stepping into post-graduation. And so as far as how a PE firm can help specifically, I'm not sure that we are doing a lot as much as supporting and partnering with an organization like Performance, who I think is approaching the right mindset here. And maybe the one thing that I would encourage private equity or investors to do is you've got to remove the focus on near-term or quarterly earnings growth and profitability metrics in the near term, because some of this is going to take some investment for the long term, and you're going to feel the pain and a little bit of that J curve as you invest in the organization for the future. And so being a supportive partner that says, hey, I know this is going to be painful for, a quarter, 6 months, or a year as we invest in our team and invest in our people, but we think we're going to come out the other end way more successful as a result. And then as far as what the organization can do, I think there's a pretty massive disconnect between employees and employers on what they're doing about the problem. A lot of employers think you can just kind of wave a magic wand and throw a larger salary and boom, it's solved. And while, certainly compensation is a huge piece of why I think we're where we're at today, that's just one lever here. And it's a short-term lever that doesn't address the work-life balance, the burnout, the exhaustion, and all the other levers beyond just compensation that are impacting physical therapists' decision to leave their organization or the industry more broadly. So I think you've got to be more innovative with the full benefits package you offer. For example, at Performance, they offer student loan reimbursement, which surprisingly, given the dynamic I just mentioned with how much of a burden that is for graduating PT students, I think only 8% of the industry actually offers student loan reimbursement as a benefit to their physical therapists for joining the organization. And then statistics would show that you've got to focus on finding the right work-life balance. Company culture is huge. Income stability for PTs over the long term. So there's a host of other levers other than just increasing salaries, or like Paul mentioned, throwing out a sign-on bonus that are short-term band-aids for a long-term problem, in my opinion. And so I think you've got to be very long-term focused with the solutions you bring to address those challenges.
And I agree with John. I think it's a lot more than compensation. When employees and employers need, consider what, I guess the total comp or the work situation looks like. I think it'll be interesting. We've obviously spent a fair amount of this hour talking about, value-based and what that looks like at the end of the day. And I think it'll be interesting to see how compensation models do, change over time to link more into the value-based arrangements on the other side. Because what I've found historically is that, most physical therapists that are in the trenches and working really have, kind of no idea what it looks like on the employer side. And I think there's probably some opportunities for the right amount of education to understand that, we just don't get paid unlimited amounts of money and then turn around and pay your salary, right? We have objectives that we have to achieve in these value-based arrangements. And I think it'll be interesting and a great opportunity to be creative and have, therapist companies think outside the box to say, hey, how do we incentivize our staff to achieve the objectives that we have under a value-based arrangement to ultimately make it a win-win-win for the, for the employer, the employee, and that company with which you may contract.
Great, thanks, Paul. And I think that concludes the initial list of topics that we plan to cover. We do have some time for questions, and I see a few have come through. If you have any questions you want us to address, you can hit the Q&A box at the bottom and type in any of your questions, and they'll pop up live for us. I think the first question that's come through, I'll have Jake kind of start on this. If you're thinking about your physical therapy practice and you're thinking about, potentially going through a transaction, what are the important things you need to consider, in terms of planning for that? And maybe Paul can chime in as well from his perspective.
Yeah. So, when thinking about these transaction processes, in all honesty, they do require, a lot of data requests and document uploads, and they can be, pretty labor intensive processes. So, if groups are potentially looking to go through a potential transaction event, we would encourage them to start gathering a lot of these document requests that are going to be needed throughout the process ahead of time. So, things like, your articles of organization, all of your contracts with payers and suppliers and vendors and things of that nature. It would be, great to have those kind of prepared and ready to go, before you actually go into the marketing or transaction process. From a financial reporting perspective, there's going to be a lot of financial reports that are required, to market the company and throughout due diligence. So, if there's any cleanup that needs to be done internally, with your accounting or EMR system, so that you can easily and quickly pull reports that are needed, for a potential transaction process, that's great to do ahead of time as well. And then, a lot of times we also, encourage our potential clients to engage with third parties as well. Things like quality of earnings providers can be a great resource to do an initial quality of earnings analysis on the business prior to going to market. So, you can potentially identify, any areas that you may do new improve on the financial front, prior to going to market, or anything else that you can do to prepare, internally with your financial reporting. They can be a great resource to help in that as well.
And I would agree with everything that Jake says. It's quite a process for those that haven't been through it. It's a lot of questions, a lot of documents you have to provide. I think the only thing that I would add, specific to the PT space, is it may be helpful as one of those third-party advisors that Jake referenced to have some audits done of charts or billing or compliance unique to PT, so that you're aware, because certainly any buyer is going to go through that exercise. And if there are issues, it's easier to identify those, pre due diligence, so that you're prepared to answer the questions, and ideally, you're prepared to correct the issues before you have to hand over 50 charts and issues are identified then that you've got to respond to that could adversely affect the transaction process.
Great, thanks, Paul. And maybe I just saw another question came through, but just the next one, I think it might be helpful, John, maybe just from your perspective. If you guys are going out and completing an acquisition of a group in your market, I mean, what are the changes that the group should expect, post-closing? We talked a little bit about how if it's working, there's no reason to change things. But I guess if you bring on a practice, I mean, what should the owner and the therapist expect in terms of things that will stay largely the same and things that might change, and how that kind of looks on an acquisition basis?
Yeah, I mean, that's where I would encourage the selling party there to really ask those questions and do those diligence, because I'll share some perspectives on how we approach it, but I'll note that we're just one party out there opposed to many. And what you're going to find on the spectrum is there's some people that'll say, you'll have autonomy and it'll feel like it is. And then post-closing, I think frustration comes when it feels like they just lost complete control of their business. And there's a lot of decisions that they thought they were going to have in their power that are now gone. And so people should have those conversations ahead of time and really understand the partner that they're looking to transact with, and have some reference calls and back channeling to make sure that person is giving you the honest answer, because there's a host of ways people are approaching it in the market. As far as our approach, it's exactly what I mentioned earlier. If it's not broken, don't try and fix it. And so sure, we'll look to take things off your hands that maybe are, one, cheaper to do in a centralized area, and or two, are not necessarily things you want to control. I mentioned it earlier. I'm not sure how many physical therapists out there have a real desire to run accounting and revenue cycle management for their practice. Certainly if they do and they have that skill set, we're more than open to figuring out the way to integrate that, because it's a need. But more often than not, there's a lot of that back office stuff that we can take off the clinics that we're partnering with, take off their hands and provide that support from them from a centralized location. But then a lot of the patient facing stuff, our view is it needs to stay the same. If they're like-minded, they share the same vision for us on elevating the PT and the way we want to impact and interact with our communities, then we're not going to go look to change the sign on their door to have some sort of ego-driven desire to have our brand name out there. We want to make sure that they're holding localized referral relationships that they held previously, and they're still managing those. And we just frankly want to find a way to share best practices. Are there things you guys are doing that's really working that we can integrate in our clinics and see better success, and vice versa? Is there stuff we've learned on how to operate and how to maximize our business model that we can share with you guys to help do things better in the way you're operating your clinics? And so it's very much a shared practices perspective on how we approach add-ons and integration.
All right, thanks, John. And I think the last question, I can start on this one. There's a question that came in just asking about, how to, manage kind of the margin squeeze that we're seeing right now with inflation, increasing salaries, reimbursement rates are best case staying flat to declining. How is this impacting PE valuations? And I think this is a theme that certainly is applicable to PT, but it's a challenge that a lot of, anyone in outpatient care, whether you're therapists or physicians, are dealing with a lot of the same, challenges on rising salaries, and there's very few industries or very few specialties within healthcare that are seeing increasing reimbursement. I think from our perspective, when you think about this and how it's impacting private equity investors' view of the market, I think the first thing is, the benefit of private equity is that you're not judged on a daily basis the value of your business like you would be in the public markets, right? So if you're looking at the public markets, even if you have a great business right now, you're being dragged down just by nature of the fact that there's a bear market and other stocks are falling. So it's sort of you're trapped into that same that same declining stock price. In the private equity world, they're obviously looking at this as a longer term strategy, right? We talked about how most investors will look at somewhere around a 5-year holding period. And if the market, when they are looking to exit, when they feel like it's the right timing for their business, if the market isn't there and valuations aren't where they expect it to be, then they might hold the business a little bit longer. So they do have flexibility on that timeline, generally speaking. And again, this is a mid to long-term strategy for these investors. So I think the view in the market is there's going to be some headwinds and challenges that folks are going to be dealing with, over the next, probably year and maybe a little bit longer. But at some point, I think things will normalize, inflation will come under control. I think there's some very early indicators that inflation is starting to, to flatten, to decline, the housing market probably being one of the leading indicators of that. So I think the expectation is, there's going to be some challenges in the short term here, but the market will start to normalize in the mid to longer term. And the companies that are, run well, providing the best patient care, looking at value-based care, those are the companies that are going to emerge, as the strongest coming out of this, some of the challenges we'll see. I think the other part of it is, any practice is dealing with the same challenges, and that's ultimately an impetus to drive consolidation, right? If you're a smaller practice and your revenue staying flat and you're seeing your margin going down and basically your earnings are falling as well, well, that might be a reason to look at consolidating together, right? Because there are some efficiencies and economies of scale you're going to get from a larger organization. And that's ultimately what private equity firms are helping to drive is, by growing and bringing in best practices and consolidating things like benefits and looking at, scale and payer negotiations. That's a way to sort of offset some of this margin decline that I think we'll see in the short term. So I think growth and consolidation certainly will be, continue in today's market, given some of the headwinds that everyone's dealing with. And again, investors kind of view that the market will normalize at some point. And I think the best companies will be best positioned to see tremendous value when they're looking to exit, 3 to 5 years from now, or maybe even longer down the road. Maybe Jake, just quickly on the question on EBITDA. I mean, I guess perspective on if you're a platform, sort of what's sort of the minimum EBITDA that you might be looking at, and obviously every fund's a little bit different. Maybe just some quick insights on that, and then we can wrap up.
Yeah, sure. So because of how much competition is out there and the shrinking number of assets remaining on the market, private equity firms are going downstream a bit for new platforms. I would say at a minimum, you probably are looking at $2.5 million of adjusted EBITDA for a starting point for a new platform. Below that, potentially you could be a regional add-on to an existing platform. But I think for private equity firms looking for a new investment in the space, typically 2.5 would be the minimum. I'd say ideally, the earnings would be between 3 to 6 million of EBITDA on the low end. Obviously the higher you go, it just introduces different tier of private equity firms, or ones that are looking to write larger equity checks. On the low end, I think that's kind of where we see the cutoff points. But below that, there's still plenty of interest from a strategic perspective, joining forces with existing private equity backed organizations, or some of the other consolidators out there.
Great, thanks, Jake. Yeah, and I think that concludes our webinar. We will have a recording of this that we'll post on our website and on LinkedIn. If there's any other questions that folks have, feel free to reach out to any of the panelists. We're happy to engage in more dialogue after the webinar. But thanks everyone for joining, and have a good rest of the day.
Thanks for having us, Eric.
Thanks.
Thank you.